Good morning and welcome to the Bulls, Bears, and the Bell Morning Edition Deep Dive. Thank you for joining us. We often talk about event risk in the markets, but honestly, it's pretty rare to see three, uh, let's call them Category 5 storms, all converging on one single trading session. Today, October 30th, 2025, isn't just looking like a busy day. It feels more like a genuine inflection point. We've got macro data, global central bank moves, and the last big mega-cap earnings hitting all at once. Our source material really frames this as having a, quote, uniquely concentrated risk profile.
Yeah, that framing is spot on, and frankly, it's needed. For you listening, this isn't just about watching the news scroll by, it's really about active risk management today. We're tracking some pretty fundamental forces that are likely going to set the direction for asset prices right through to the end of the year. So whether you're positioned for growth, looking for yield, or even just sitting in cash, the outcomes from today's, well, three main events really demand an immediate tactical response.
Okay, let's unpack this triple threat then. We've got these crucial windows opening up before the market opens, kind of during lunch, and then after the close. What are the key things we absolutely need to be watching today?
Well, it's like layered shocks coming through the system. First up, 8:30 a.m. Eastern, we get the big one for the U.S., the Q3 advanced GDP figures. That sets the immediate tone for, the Federal Reserve. Second, just as that domestic data starts to settle, we have these simultaneous and really critical monetary policy decisions coming out of Europe, the ECB and also the Bank of Japan. These two moving potentially in sync or maybe diverging. They fundamentally shift global liquidity and currency dynamics. And then finally, bookending the whole session, we have those really high stakes, kind of last chance mega cap earnings from Apple. That's APL and Amazon, AMZN coming after the market closes.
Wow. Okay, when you stack it up like that, you'd almost expect the futures markets to be, I don't know, completely freaking out, pricing in some massive swing one way or the other. But looking at the pre-market vibe right now, it's weirdly neutral, almost suspiciously quiet. S&P 500 futures, they're hovering near 6,890.59, barely moved, up like 0.0044%. Dow futures are actually seeing a little bit of pressure, down about 0.16%. It feels less like positioning and more like the market's just holding its breath.
That's exactly it. That cautious neutrality is what we really need to dig into. Because that neutrality, it's actually hiding a deeply mixed signal, and the deviation, the place where you see the difference, is in the growth stocks. Look at the NASDAQ composite futures. They're actually mildly bullish, up about 0.55% at 23,958.47. So what that suggests is that investors are, while still chasing that earnings momentum, they're placing a pretty high bet on these tech giants delivering positive surprises, almost ignoring the big macro storm clouds gathering overhead.
Right, so we have this clear split. The broader market's kind of frozen by the macro fear, but tech is still running on fumes of optimism about, corporate earnings power. And this contradiction, it really mirrors the whole ambiguity around the Fed, doesn't it? After their last move, we've just heard this drumbeat of hawkish rate talk. The market just doesn't seem to know whether to be more scared of a recession or scared of the Fed's reaction if things look too hot.
Exactly. And that ambiguity, that uncertainty, it leads us straight into our first big showdown of the day.
Okay, the ultimate score, as you called it, for the U.S. economy, 8:30 a.m. Eastern, Q3 advanced GDP. We've established it's probably the single most influential number today, but let's dive into that core paradox you mentioned. If this number comes in surprisingly strong, let's say it blows past the 2.8% consensus forecast. Why is that potentially bad news for the stock market? Doesn't strong growth mean the economy is resilient?
It's the classic good news is bad news scenario, and it's all driven by the Federal Reserve's current mandate. Right now, the Fed has one job, really: get inflation down to their target. That's the overriding goal. And they've basically signaled they're willing to tolerate, maybe even engineer slower growth to make that happen. So if we get a surprisingly strong Q3 GDP print, especially, anything north of, say, 3.2%, that serves as pretty definitive proof that the economy is not slowing down enough on its own to really curb those underlying inflation pressures.
And if the economy isn't cooling naturally, the Fed feels obligated to step in and do the job for it, which means that whole higher for longer interest rate policy gets cemented, right? Or maybe even extended.
Precisely. And this is where the tactical thinking becomes absolutely crucial for you listening. When interest rates are higher or are expected to stay higher for longer, it changes the entire math for valuing assets, especially long-duration assets. We're talking about stocks here, particularly those high-growth tech companies whose value is based on earnings expected many years down the road. The basic tool everyone uses is the discounted cash flow, or DCF model. And when that risk-free rate think Treasury yields, the baseline for your discount rate goes up, the net present value of all those future earnings gets squeezed, it contracts, sometimes dramatically.
Okay, so a strong GDP number isn't necessarily a sign of robust economic health in this context. It's actually a signal that the cost of capital, that discount rate, is likely going up or staying high, which makes current stock valuations look, well, unsustainable.
Correct. So the strategic recommendation here is pretty clear. Portfolios really need to have some kind of hedge against a strong Q3 GDP outcome. That means being ready to implement, maybe proactively, a risk-off rotation. In that scenario, you'd expect to see those long-duration growth assets, particularly tech, sold off pretty aggressively. Capital would likely flow out of things like the Technology Select Sector ETF, INFT, and into more defensive areas, think consumer staples, utility sectors that are less tied to the economic cycle and often have stable dividends. And alongside that, we'd expect to see a pretty sharp rally in the US dollar index, the DXY, and a significant rise in yields at the short end of the Treasury curve as the odds of future rate hikes climb.
That makes sense. So watching the fixed income market, especially something like the 2-year Treasury yield right after 8:30 a.m., becomes a really good leading indicator for how equities might react. If that yield spikes, stocks are probably in for a rough ride, regardless of the headline GDP number itself.
Absolutely. The bond market will price in that expected Fed reaction almost instantly. But we also need to look under the hood of that headline GDP number. We're also getting some key secondary data points at the same time. Initial and continuing jobless claims. These are, high-frequency reads on the health of the labor market.
Right, a quick reminder for everyone. Initial claims are new filings for unemployment, signaling recent layoffs.
Yeah.
Continuing claims are people still getting benefits, which tells us how hard it is for them to find a new job. So low numbers, subdued claims, that points to a really tight labor market still.
That's right. And a persistently tight labor market, even if the headline GDP number comes in a bit weaker than expected, it severely limits the Fed's wiggle room for any kind of policy easing or accommodation. Chair Powell has been crystal clear that labor cost pressures, wage growth, are really central to their view on structural inflation risk. If wages stay sticky because workers are scarce, well, inflation is just going to be that much harder to bring down.
Now, you mentioned a dangerous scenario earlier. Let's maybe explore that worst-case combination, the one that really stokes those stagflation fears.
Yeah, the really tricky, dangerous scenario for asset allocators is if we see a spike in initial jobless claims suggesting the economy is starting to slow down, layoffs are picking up, but that's paired with a, say, moderately strong GDP print and sticky, high continuing claims.
Okay, why is that specific mix worse than just a straightforward strong GDP number?
Because it suggests the economy is starting to fray around the edges on the jobs front, but the underlying price pressures haven't really eased up yet. That combination, slowing growth plus sticky inflation, is the textbook definition of stagflationary fear. And in that kind of environment, the policy choice for the Fed becomes absolutely agonizing. Do they fight inflation by raising rates, which hurts growth even more? Or do they try to support growth by cutting rates, which risks letting inflation run hotter? That kind of ambiguity, that policy paralysis, it translates into extreme market volatility. Nobody really wins in that scenario. It guarantees policy stays rigid and uncertainty reigns.
Okay, so once the dust from the U.S. macro data starts to settle, maybe mid-morning, the focus shifts globally. Our sources are really stressing the importance of these synchronized central bank decisions, the ECB and the Bank of Japan. Why is it so critical to watch sovereign debt and currency markets right after these decisions drop?
It all comes down to global liquidity flows. You've
Yeah.
got the European Central Bank, the ECB, and the Bank of Japan, the BOJ. They oversee two of the world's three biggest currency zones, right? So when they make a move or even just drop a hint about a future move, they immediately shift the demand for their own government bonds. And that instantly impacts global capital flows, the relative value of currencies, which then ripples out and affects the pricing of pretty much everything, from commodities to how companies hedge their international sales.
Got it. Let's start with Europe then. The ECB makes its call at 1:15 p.m. Eastern. Consensus seems pretty solid on them holding the main rate at 2.15%. So if the rate's not moving, the real action today is all about the press conference afterwards, listening to President Christine Lagarde's tone and language.
Absolutely. The context here is really important. Recent data out of the Eurozone has actually been, well, surprisingly resilient. We saw their Q3 GDP come in at 0.2% growth, which beat the 0.1% consensus. Unemployment held steady at 6.3%. And maybe more importantly, some of those core inflation metrics are showing signs they might be stabilizing, albeit at pretty elevated levels.
So that stronger data gives the ECB some breathing room. They don't necessarily have to ease policy, but they're not under intense pressure to hike further either.
Precisely. That resilience gives the ECB the confidence, maybe the justification, to keep rates restrictive for longer. It's the Eurozone's own version of higher for longer. So the market is going to be dissecting Lagarde's press conference with a fine-tooth comb. Every phrase, any reference to the duration or the level of restrictiveness of current policy is going to be scrutinized intensely.
Okay, so if Lagarde comes across as hawkish, maybe emphasizing that duration aspect, what's the immediate market reaction likely to be?
A hawkish Lagarde reinforces that restrictive stance. So you'd likely see upward pressure on Eurozone government bond yields, especially the benchmark German 10-year bonds, as investors price in rates staying high for longer. That yield difference between Europe and the U.S. that then provides strong underlying support for the euro against the dollar, the Eurozone exchange rate. Now, a stronger euro helps keep import prices down in Europe, but it does hurt Eurozone exporters. And maybe more subtly, keeping policy tight for longer increases the risk of what they call fragmentation, basically. Stress in the bond markets of highly indebted countries like Italy. So watch those spreads between German and Italian yields, too. That could be a key volatility spot.
Right. Okay, shifting focus across the globe now, let's talk about the Asian angle.
Yeah.
The Bank of Japan. Again, a policy hold on their current target rate of 0.5% is widely expected. But you mentioned the stakes here are arguably even higher, given the BOJ's really unique kind of interventionist policies.
Yeah. The BOJ is the ultimate global outlier right now. They're still maintaining this ultra-loose monetary policy, and the key mechanism is their commitment to yield curve control, or YCC. Just quickly for listeners, YCC is basically the BOJ promising to buy however many Japanese government bonds it takes to keep the 10-year yield from rising above a certain level. They effectively cap long-term rates.
Okay, so why does whether they stick with YCC or tweak it matter so much globally?
Well, Japan is the world's largest creditor nation. Think about Japanese institutions. Big pension funds, insurance companies, they hold massive amounts of foreign bonds, especially U.S. treasuries. Why? Because their own domestic yields have been artificially suppressed by YCC for years. So they've exported huge amounts of capital, searching for better returns elsewhere.
Okay, I see the potential domino effect now. If the BOJ even hints at normalizing policy, maybe letting yields rise a bit, suddenly Japanese bonds look more attractive to Japanese investors.
Exactly. The shock risk here is potentially huge. Any deviation from the current YCC framework, or even the slightest, most subtle hint in their statement about maybe tweaking the YCC ban in the future or suggesting an end date, that could trigger an immediate and potentially massive acceleration of capital repatriation. Japanese investors would start selling their foreign assets, U.S. bonds, European bonds, you name it, to bring that capital home and reinvest in Japanese government bonds, JGBs, or other yen assets that suddenly look more appealing. That flow would instantly push the yen higher, weaken the U.S. dollar against the yen, and could potentially suck liquidity out of global bond markets. It requires really proactive risk management across any international portfolio. That's the potential global shockwave we're keeping a very close eye on, expected around 3:00 a.m. Eastern.
All right, so we move from the big picture macro and global policy shifts to maybe the final and arguably most consequential corporate hurdle today, those mega cap earnings after the closing bell. We're talking Apple, AEPL, and Amazon, AMZN. These two, I mean, they just represent such a massive slice of the S&P 500's total market value.
Their importance today is definitely amplified by the incredibly high bar that's been set by their peers recently. We've already seen other members of that Magnificent Seven groupthink, Alphabet, Meta, even Microsoft. Their shares actually declined after they reported earnings that technically beat consensus estimates on revenue and profit. What that tells us is the market isn't really impressed by past performance anymore. It's laser-focused on perfect forward guidance and clear evidence of superior efficiency. You know, a beat without a really spectacular outlook, that's now considered a miss.
Okay, let's dive into Apple first. The iPhone, obviously still critical, but beyond just unit sales, what are the big institutional investors really zeroing in on in the AAPL report tonight?
Yeah, the market seems to have pretty much priced in, moderate iPhone growth. The real justification for Apple's premium valuation now rests almost entirely on the health and the growth trajectory of their high-margin services division. We're talking App Store revenues, iCloud subscriptions, Apple Pay, their growing advertising business. This segment boasts profit margins that are often north of 70% compared to maybe the mid-30s for hardware. It's a huge difference.
So if that services number disappoints, the whole valuation argument kind of takes a big hit.
It creates enormous pressure, yeah. Investors are probably looking for services revenue growth of at least, say, 15% year over year to really maintain confidence in Apple's long-term story that transitioned from being seen as a cyclical hardware maker to more of a stable, high-margin subscription business. But here's where it gets really interesting this quarter. All of that, even the services number, might get overshadowed by any commentary or lack thereof on future capital allocation, specifically regarding that internal AI development efforts.
Right. We've seen Microsoft and Google especially be really aggressive in positioning themselves as the leaders in AI. What does Apple need to communicate here?
They basically need to prove they aren't being left behind in this whole generative AI arms race. Investors are going to be hunting for any specific guidance on R&D spending dedicated to AI, maybe hints about strategic acquisitions in this space, or even new AI-powered features coming to their devices that leverage these large language models. The market desperately needs reassurance that Apple has secured its next major growth engine. If there's silence on AI or just vague commentary, it's likely going to be interpreted as, well, strategic complacency, even if the core services numbers look great.
Okay, shifting over to Amazon. You highlighted AWS, Amazon Web Services, as maybe the single most important factor, not just for Amazon, but for the entire tech market tonight. What exactly is this cloud contradiction that portfolio managers are apparently wrestling with?
Yeah, this contradiction is systemic, and it really ties back to these big corporate spending cycles or CapEx cycles. On one hand, we're definitely seeing ongoing evidence of a general slowdown or deceleration in basic cloud spending. Companies, nervous about the macro picture are continuing these optimization efforts. Basically means they're cutting back on migrating simple IT tasks to the cloud, or they're trying to squeeze more efficiency out of the cloud capacity they already pay for.
Okay, but on the other hand, seemingly every large company is rushing headlong into adopting AI, which needs massive cloud power.
Precisely.
Yeah.
And that AI adoption requires huge amounts of specialized, high-performance computing infrastructure. So the core question for institutions is this. Is the acceleration in spending on these high-cost, high-compute AI workloads, which mostly run on platforms like AWS, is that acceleration robust enough and happening fast enough to successfully offset the deceleration we're seeing in that general lower-margin cloud optimization spend from everyone else?
Wow. Okay, so if AWS growth comes in below expectations tonight, that's not just an Amazon problem. You're saying it could actually undermine the whole AI investment story that's been propping up so much of the market lately.
It's absolutely a systemic risk because AWS is seen as the bellwether for overall enterprise technology spending. If they signal weakness or if their growth isn't meeting these very high expectations, it strongly suggests that this massive AI capital expenditure cycle, which has been the backbone of the recent market rally, is either weaker or maybe just slower to materialize than the market is currently pricing in. That kind of scenario could easily trigger a really widespread systemic sell-off across that entire AI infrastructure chain. You'd see heavy selling pressure not just on Amazon, but also on key suppliers like NVIDIA, NVDA, AMD, and various other component makers.
So while everyone's looking at the headline revenue and margins for AWS, what's the single most crucial indicator within the AMZN release that portfolio managers need to latch onto as a forward-looking signal?
It is unequivocally Amazon's guidance regarding their planned capital expenditures, or CapEx, specifically for data centers. CapEx is basically the money they spend today to build the capacity that will generate revenue tomorrow. So a really strong CapEx commitment, like if they significantly raise their previous spending guidance that signals supreme confidence, confidence in the rapid adoption of AI services, and the need for a lot more computing power in the future. Conversely, if their CapEx guidance is conservative or maybe even reduced, that signals caution about future demand. And the market would likely interpret that as undermining the whole AI narrative, potentially leading to a pretty severe downward re-rating for the stock and the sector.
Okay, while those tech giants definitely dominate the headlines, the underlying market action, especially in the pre-market, can reveal some really crucial thematic shifts. We should look at some of these high-magnitude, company-specific moves. They often give us those little aha moments about what the smart money is actually prioritizing right now.
Yeah, we've definitely seen some pretty explosive moves this morning, often driven by very clear catalysts that seem to confirm these highly sought-after investment themes. I mean, the most dramatic example has got to be Cambium Networks, ticker CMBM. It surged, get this, an incredible plus 262.5% on really substantial volume too, over 200 million shares traded. and the driver.
No.
They announced an integration that's going to leverage Starlink technology to offer enhanced enterprise services.
Wow, yeah, that jumps right out. It's not just about, next-gen connectivity in general. It signals huge investor appetite for companies that can actually integrate and monetize that leading satellite tech, making it usable for corporate clients. That's a big deal.
Exactly. And we saw similar confirmation over in the specialized healthcare space. Purple Biotech, PPBT, that jumped over 83% after they hit a key manufacturing milestone for a complex therapy, a trispecific antibody. In the biotech world, this kind of news is a classic de-risking event, confirming you can actually manufacture a complex drug at scale. That removes a massive commercial and logistical hurdle. It translates almost immediately into higher future profit estimates and, just as importantly, lower perceived risk.
Okay, but on the flip side, we also see some notable decliners where maybe seemingly good news just wasn't enough to overcome some underlying pressures. Like GPUS was down almost 14%, despite announcing it was expanding its Bitcoin mining capacity. That sounds kind of counterintuitive, especially if crypto sentiment is generally positive.
Yeah, this is a perfect example of where fundamental sector-specific worries are outweighing a tactical headline. The market seems to be signaling that even with that expansion, the underlying economics of Bitcoin mining, the cost structure, the profitability remain really deeply challenged. Investors are likely focusing on things like sky-high energy costs, the rapidly increasing competition, which just crushes margins, and the sheer amount of capital needed to constantly upgrade equipment to stay competitive in mining hash rates. It suggests the financial pressure on these independent miners is still severe, regardless of any headline growth announcements.
We also saw NVD drop about 6.8%. Now, given how central that AI narrative is, any sign of weakness in related components or infrastructure names seems like it demands pretty close scrutiny, right?
Absolutely. NVD's performance here acts almost like a proxy for underlying caution in the sector. If a component supplier shows that kind of weakness, it might suggest some internal pressures, maybe around inventory management, or perhaps even a subtle shift in order patterns from their larger clients. And given that the whole AI hardware sector really hinges on confidence in future CapEx spending, any weakness like this gets immediately scrutinized for potential negative read-throughs. Does this mean Amazon or Apple are already quietly tapping the brakes on some component orders? It raises those kinds of questions.
Okay, let's pivot now to the more sophisticated side of the market, options flow. This can sometimes give us a kind of deep whisper, an insight into where institutions are placing really high conviction, concentrated bets, often signaling underlying shifts that you might miss just looking at stock prices.
Yeah, we observed some pretty extraordinary activity in two names in particular. First, take Western Union, WU. We saw absolutely massive call volume roll through nearly 64,000 contracts traded. That's like 7 times its average daily volume, and it was 40 times the put volume, just completely skewed to the upside. And significantly, this volume was heavily concentrated in the December $10 strike calls.
Wow. I mean, that is pretty much the definition of sustained high conviction bullishness.
Yeah.
Especially, like you said, considering WU has already rallied over 17% recently. They're clearly betting this move has legs, that it's structural, not just a short-term pop.
Precise. They're using those options to get leveraged exposure to a directional bet on continuation. But maybe the most sophisticated trade we saw was over in Carrier Global, KER. KAR saw this huge spike in call volume, 11 times its daily average, and it was largely driven by a massive and very explicit bullish risk reversal strategy that traded over 10,000 times in one go.
Okay, for our listeners, let's maybe unpack that risk reversal a bit more. Why is that specific option structure considered such a strong sign of extreme confidence by the trader putting it on?
Right, so a bullish risk reversal is essentially a synthetic way to get long the stock. What the trader does is simultaneously sell an out-of-the-money put option and buy an out-of-the-money call option. In SIRR's case, the specific trade was selling the $50 strike puts and buying the $65 strike calls. Now, this is a really capital-efficient way to express strong conviction.
Okay, so why sell the put? By selling the put, they're taking on the obligation to buy the stock down at $50 if it falls that far.
They sell the put for two main reasons. First, the money, the premium, they collect from selling that put helps to finance, or at least partially offset, the cost of buying the call option. So it makes the whole bullish bet cheaper, sometimes even close to zero cost. But second, and maybe more importantly from a signaling perspective, by being willing to own the stock down at $50, which is below where it's currently trading, they're signaling absolute confidence in the company's underlying value floor. They're essentially saying, we're happy to buy it down there. So it's this powerful two-part message. We think the downside is limited, and we are absolutely convinced it's going significantly higher, likely above $65. It really confirms strong institutional belief and some significant future upside for that industrial name.
That kind of conviction we're seeing in the options market seems to be reflecting in the broader sector rotation patterns, too, which we can track using those SPDR sector ETFs. Our source material highlighted a pretty sharp divergence between the growth sectors and those that are really sensitive to interest rates.
Yeah, that divergence is almost a textbook reflection of this whole higher for longer rate environment we're in. Technology, if you look at the technology select sector SPDR INFT, it's maintaining that structural strength. It was up about 0.81% in the pre-market. But conversely, those sectors that are highly sensitive to the cost of money, the cost of capital, they're getting hit pretty hard. Financials, the FNL ETF, showing notable negative momentum, down about 1.67%. And real estate, that was sharply in the red, declining almost 2.75%.
Right, so this really confirms the market's deep conviction in that growth over value thesis, even with rates staying elevated. Real estate especially just gets crushed when borrowing costs remain high and sticky like this.
Absolutely. I mean, the entire real estate sector is fundamentally dependent on low borrowing costs, right? For financing new acquisitions, for development projects, and crucially for refinancing existing debt loads. So when the Fed confirms policy is going to stay rigid, those refinancing risks suddenly become much more acute. Valuations, which are often based on capitalization rates, they widen out almost immediately. Financials tend to suffer too because higher rates can compress their net interest margins, their NIMs, especially if they can't reprice their loans faster than the deposit costs rise, or if they start facing rising worries about credit quality linked to a rate-induced economic slowdown. The key takeaway here is that capital just keeps concentrating in those sectors believed capable of generating their own growth, largely irrespective of the broader macro cost of capital.
Okay, and alongside these rotations, we also have some pretty critical earnings reports due out before the opening bell today from major players in industrials and healthcare. Names like Boeing, BA, Caterpillar, CAT, Oshkosh, OSK, and Bristol-Myers, BMY. Focusing on the industrials first, beyond just the headline earnings per share estimates, what specific metrics are analysts really going to be hunting for in reports from like CAT or OSK?
Yeah, for the big industrials, the focus has really shifted away from just simple demand levels towards operational efficiency and, critically, supply chain stabilization. Analysts are looking for confirmation that those cost pressures that plague them, things like freight costs, raw material inflation, labor costs, are actually starting to normalize in a meaningful way. So the key analytical focus areas will be the health of their order backlogs as it indicate good future demand visibility. And maybe even more crucially, what's their free cash flow, FCF generation, looking like? FCF is really the ultimate measure of operational health and resilience. If they're generating strong free cash flow, it confirms they're successfully translating that top-line revenue into actual cash, even in this tight money environment.
Makes sense. And for the healthcare names reporting, like Bristol-Myers, what's the key angle there?
For the big pharma names within the healthcare select sector, HLTH, the focus tends to be on pipeline health. Any updates regarding clinical trials, particularly in high-demand, high-margin areas like oncology or immunology, are key. Investors also need confirmation that these companies can successfully navigate the ongoing risks around drug pricing legislation while still maintaining robust spending on research and development. Strong guidance from a name like BMY would lend support to the entire healthcare sector, potentially reinforcing its role as a defensive ballast against some of the high-growth volatility we might see later today from tech.
All right, let's try and bring all these threads together now. If you had to consolidate this sheer volume of information, all these moving parts, into the three most concentrated shock scenarios that listeners really need to be vigilant about today, what would they be?
Okay, yeah, despite all the noise, I think it boils down to three primary shock scenarios, all uniquely concentrated in today's session. Number one is the macro shock, overhitting confirmation. This is where the US Q3 GDP number comes in significantly hotter than expected, let's say north of 3.2%. And importantly, it's driven by strong components like personal consumption or business investment. That kind of outcome instantly confirms the economy is overheating and essentially guarantees the Fed stays hawkish, maybe even gets more hawkish, the market response. Likely a mass, potentially a leverage flight out of long-duration growth assets, tech especially into cash, short-term bonds, and defensive stocks. Expect serious selling pressure on the Nasdaq. Number two is the corporate shock. Invalidating the AI narrative, this hinges entirely on Amazon. An AWS revenue miss, or maybe more subtly, guidance where they seriously disappoint on future CapEx spending plans. Since AWS is seen as validating that whole enterprise AI spending thesis, a failure there would essentially invalidate the extreme valuation premium currently baked into the technology select sector. This could trigger a rapid systemic sell-off impacting the entire AI ecosystem, way beyond just Amazon itself. And number three is what I'd call cross-contagion risk, the recession fear pivot. This is a scenario where multiple negative data points start reinforcing each other. So imagine if those major industrial earnings reports from Boeing and CAT come in weak, showing poor operational improvement or shrinking backlogs. And then maybe that's compounded by signals that the US ISM manufacturing PMI, which is due out tomorrow, but the market often anticipates it looks like it's going to print substantially below that key 50 level, signaling contraction. In that situation, the market's focus could dramatically pivot away from inflation worries towards outright imminent recession fears. That would likely drive flows into traditional safety assets like gold and long-duration treasury bonds. Hashtag tag outro.
Okay, it is crystal clear that navigating today successfully really hinges on what our sources called effective disparity management. That's the ability to interpret this inherent tension, this push and pull between potentially strong economic data on one hand and the near certainty of continued restrictive central bank talk on the other. You're basically walking a tightrope between signs of growth and the reality of rising risk-free rates.
And that tightrope, as tricky as it is definitely laced with opportunity as well. Despite all the risks we've laid out, we have identified some of these emerging zones where conviction seems high. So to reiterate those technical opportunities, first, potentially leveraging that clear institutional momentum we saw indicated by those massive directional options trades in names like Western Union and Carrier Global. That's where big money is placing its bets. Second, maybe maintaining targeted overweight positions in sectors that are showing broad earnings strength and operational clarity, like some of those specialized areas within healthcare, HLTH, or selective industrials, INDU. They can act as a really important ballast against the potential volatility in high-growth tech.
And finally, that global policy action today opens up potential FX volatility trades, right? Especially focusing on any deviations from the consensus expectations for the ECB or the BOJ guidance.
Precisely. I mean, if Lagarde surprises everyone by sounding decisively more hawkish than expected, the euro is likely to strengthen significantly against the dollar, offering a pretty clear directional trade there. And if the Bank of Japan offers even the faintest glimmer of a future adjustment to yield curve control, that yen volatility trade could absolutely explode, creating some potentially unparalleled short-term opportunities for global macro-focused traders.
We really have to end, though, on the paradox that seems to define this entire session. Despite this truly unprecedented concentration of major risk events GDP, two major central banks, the last two Magnificent Seven earnings reports the CBOE Volatility Index, the VIX, is just conspicuously low. It's sitting down near 16.02. I mean, it's the market's fear gauge, and right now it seems to be signaling relative calm right in the face of a potential tsunami.
It is a really remarkable divergence, isn't it, between the implied volatility priced into options, which is what the VIX measures, and the sheer amount of actual event risk staring us in the face. This low VIX level could imply one of two things. Either there's pervasive market complacency, people just aren't worried enough, or maybe more strategically, it could mean that the really sophisticated institutional players have already put on complex hedges outside the standard VIX options market, maybe using alternative products, or perhaps they're simply holding massive amounts of cash on the sidelines.
So the final thought for you, the listener, has to be this. What does it actually mean for your portfolio if the VIX is signaling relatively contained risk? But we know that a negative surprise in any one of these three primary catalysts today could trigger a truly rapid, dislocated spike in volatility. We could see the VIX surge 30% or more in just a matter of hours.
It means that the current VIX pricing could be a potential trap, just waiting for that catalyst to spring it. If the market's collective bet on contained risk turns out to be wrong, that rapid spike in volatility will severely punish any strategies that haven't already pre-planned their tactical countermeasures. The need for clearly predefined stop-loss points, for agility in deploying capital, has honestly never been more paramount than it is today. Stay vigilant, because starting at 8:30 a.m. Eastern, the race to reposition begins in earnest.